All right, class, settle down now. Welcome to our sixth and final episode of our Back to Tax Reform series at the Simply Tax School. Today, we'll hear from BKD's Gary Genenbacher on insights from applying the provisions of the Tax Cuts and Jobs Act to financial institutions.
The question of taxation touches every home in America.
Cutting through the static of the tax world, it's Simply Tax.
Hello and welcome to the final episode of our Back to Tax Reform series here on Simply Tax. As you know, the tax world is vast, so clearly there are a lot of insights and industry perspectives that we weren't able to get to during our series. But don't worry. Earlier this month, I had the pleasure of hosting 2 webinars where we dug in on what we learned from tax reform, with one webinar focused on lessons learned for individuals and the other for businesses. In the webinars, we provide a brief overview and summary of where we stand on tax reform and devote most of the time to answering audience questions. We tackle things like qualified opportunity zones, charitable giving after tax reform, the 20% of qualified business income deduction or Section 199 Cap A, the new business interest expense limitation or Section 163J, insights from private equity, M&A, and just a whole lot more. You can find links to the archived recordings of the webinars in the show notes of this episode, which are available at bkd.com/simplytax. And speaking of audience questions, here's one emailed in from Simply Tax listener Chris, who writes, "Why has needing to know what rises to the level of a Section 162 trade or business become such a hot topic in recent years?" That's a really great question, Chris, and one that has a long history, but as you point out, has become more significant in the tax law as of late. The trade or business topic is particularly challenging since it's an inherently factual determination as discussed in the preamble to the final regulations under Section 199 Cap A, and the term trade or business is not defined in the Internal Revenue Code, the Treasury regulations, or in other IRS guidance. Add to it the challenges of determining the extent to which certain activities like, say, rental of real estate rises to the level of Section 162 trade or business, which can be particularly challenging due to the nature of the business and the inherent investment-like qualities of holding real estate for long-term appreciation, and you've got yourself one complicated area of the tax law. To answer your question, I'd say the issue has risen in significance in recent years due to new provisions, like the net investment income tax, which we discussed in episode 67 with David Kirk, the qualified business income deduction, Section 163J, and qualified opportunity zones, to name a few, which all look to the Section 162 trade or business definition, which is a little like asking a freshman in high school to meet you at the pool above the gym on the first day of class, when you know the school doesn't have one. I took a deeper dive on the topic as it applies to rental activities in a short insight video on our Simply Tax YouTube channel, which you can also find a link to in the show notes of this episode. Whether an activity rises to the level of a Section 162 trade or business is an important question to ask, and one that I've been personally asking and documenting on the returns I've been looking at this tax season, given its increased significance after tax reform.
What's going on here, Mr. Martin?
Oh man, we're late for class. Here's a little bit about our guest today before we bank on his insights for financial institutions.
Name's Gary Genenbacher. I'm a tax partner in our Decatur, Illinois tax practice. Spend a large amount of my time family-owned businesses, and in particular in the financial services space as well, with both regular and S corporation clients. On the tax side for over 28 years, and in public accounting for over 30 now. So some would say I'm in the sunset of my career.
Obviously, so much has been said, and we've talked so much about tax reform and all those changes and what it's meant. With your background, your experience, I think you have a pretty good perspective to add on, what it was like to apply these provisions.
I wish there would have been more folks around who went through 86. I started in 88, so I missed the last reform. But I guess the perspective I've gained over the decades would be, as a tax professional, we've had regulations that come out on a regular basis, revenue procedures, revenue rulings, court cases. So over the past 3 decades, the 86 Act, if you will, was continuing to be developed, applied, interpreted. And I think that gave me probably maybe the baseline to really think through what are we trying to accomplish here with this tax reform. A lot of information we need to apply, but we have to take a deep breath, try to gain an understanding of the spirit of what changed, apply it, knowing that there will be additional interpretations that are going to come out well beyond, my career. So take a deep breath, understand, learn, and frankly, that's probably been one of the most exciting things about tax reform is the opportunity to, dust off the gray matter and keep learning, because that's what our clients expect.
That's the thing that makes it interesting to me. I enjoy learning and problem solving and all that. I mean, that's why I became a tax professional in the first place. So I mean, this is like prime time.
Yeah, it's still fun.
Yeah,
it's still fun, Damien, and that's the impetus we need each morning to get up.
There you go. Someone once told me, if you're passionate about what you do, then you won't work a day in your life. I don't know. I mean, maybe some days I feel like it's a little bit like work, but I will say that it served me well overall, just to kind of follow that advice. So
yeah, great advice.
Looking back here, we've had our first filing season, and we still obviously have some returns on extension here. What's it been like to apply those revisions from tax reform in this first filing season for financial institutions?
I'd attack it a couple ways. I guess we'd had rhetoric going back, clear to, it may have been 2016, right? Inklings that tax reform was coming, and here's sort of where we thought it might land. And then towards the tail end of 17, we thought, hey, let's go off for the holidays because nothing's going to happen. And, I was driving to a train station to pick a kid coming up, and all of a sudden, here goes the email blast that they signed it. And it's like, oh my goodness, now what? So back to the 16, we had inclinations that rates were going to go down. And so we started thinking about accounting method changes. What kind of things could we do in a lower tax environment to, if you will, accelerate deductions back into those high tax years? And so, things as simple as, let's take a look at cost segregation studies and really try to accelerate tax deductions into that last or even in 16, maybe get a couple years worth of higher tax rate but greater benefit to deductions. And then when 17 hit and we had the acceleration of these provisions, those same strategies still applied. And so, we had a lot of interesting discussions around accounting for income taxes and getting the deferreds adjusted to where they needed to be for our regular corporation clients. And so the ability to maybe stuff $1 million of depreciation deductions into a high tax year created additional capital for a bank. And then additional capital for a bank, may have some implications on their legal lending limits. And we know that banks make more money when they loan money and get collected versus investing money or put it in Fed funds. So the ability to take tax and help create margin. Those were definitely some exciting times to really make an impact. Another takeaway I guess I had was from tax reform and the implementation of these things with, even in 17, but especially in 18, is they really came out and defined in my mind what a small business is. And throughout reform, there were multiple inferences at this $25 million average gross receipt figure. And if you think about it, the IRS with limited resources and doing less audits, they sort of took, I think, this mindset of let's not look at certain items anymore on audit if it's just a timing difference. And that's where they gave us these extra rules on accounting methods and the definition of a small business, meaning 25 million in receipts. So we've had a lot of fun with accounting methods for regular corporations, being able to take them cash basis if it made sense, and other provisions. But overall, the largest takeaway, rates went down. If you were a regular corp, your federal rate went from 35 to 21. If you were an S corporation that in theory was able to take advantage of the qualified business income, you went from 39.6 to effectively 29.6. So in the banking space, everyone's taxes fairly well went down. And then that was just a wonderful wonderful boom. And corporations could either, buy back shares, pay their employees more, get more competitive with employees, pay out more dividends to the shareholders, reinvest in capital. Frankly, it felt like an economic boom for our clients.
I guess as you've been going through that and seeing that, was that really set into that realization set in for everybody? And you're seeing that from the activities in the business or the conversations that you're having with the banks and the financial institutions?
I'd say for the most part, yes, it's definitely settling in. Now, human nature always likes to focus on, the negatives. Hey, my rate went down, but now I can't deduct this or that. So, we get pushback, we get the cocktail conversations. Hey, I heard this or I heard that. But for the most part, we're dealing with rational, sophisticated individuals, and they understand that taxes are a byproduct, and they're thirsty for education on tax reform as it relates to, one, what can help them build a better strategy to run their business, and then two, are there any nuggets that can help their customers, better pay those loans back?
I guess in those conversations, whether it be cocktail or otherwise, what's been some of the most, I guess, surprising aspects of the provisions from those conversations?
I would say meals, entertainment. It started off, you first read the headline, hey, all entertainment's no longer deductible. Then after some clarification came out saying, hey, folks are now giving away their tickets to charity to gain a deduction, and steak dinners are back in vogue, because now at least when you have your business meeting, if it's at a restaurant, 50% is deductible. And so, some behaviors change. So that's one aspect of, gaining an understanding of what was going on. Accounting for income taxes was a sort of a surprise, I guess, in the sense that folks forgot about it. A lot of our clients have deferred tax liabilities, which when those get written down to a lower rate, that's positive for an institution. But in a lot of our banks, they have these large deferred tax assets due to their allowance for loan loss not being deductible until you actually charge off a loan. They had some hits to capital, and so those weren't real excited. But then they understood that each month they were able to book a less tax expense, and they really quickly earned those monies back. For our S Corp banks, there was sort of this uncertainty on whether or not they'd qualify in totality for the qualified business income deduction. So I think we were able to, educate them through the process. And, later when some guidance came out saying mortgage servicing rights is banking. So if you service a mortgage and you get to keep those 25 basis points of the into income, that didn't disqualify the overall organization. So that was very positive. And then it really allowed them to truly see, the benefits of that lower bracketing. We had lots of conversations around parking, and oh my gosh, do we really have to count the number of parking spaces in each of our facilities and analyze them facility by facility? And the answer was, well, yes, that's unfortunately what the rule says. Remember, we're the messenger, but your rates did go down 10%, so this is just a little clawback. But then it came into, conversation about maybe you should move down the parking space that says, for the president, and you no longer had a dedicated space. So those were some of the things, I guess, taking away, not all ahas, but definitely the basic blocking and tackling we need to do as professionals that, our clients appreciate.
That's been probably a little bit challenging, and something we've talked quite a bit about, Gary. Phone calls, emails, otherwise. Even as we were kind of getting ready here before we hit record, right? About some of the areas where the guidance, or really more specifically the lack thereof, has been a bit challenging this tax season. So, would you agree that's been challenging? And what are some areas that you're particularly looking for in terms of the guidance perspective?
Definitely challenging in the sense that, every day you would hear somebody have a snippet about, is this the interpretation? Is that the interpretation? So in the banking, space right now, we're still waiting on some guidance from under 481D for those code heads out there, whereby if you were a regular corporation and you decided to go to S corporation, they put in special provisions to say, hey, the deferred items that you come back, any accounting method changes that you now have to change and take on as a consequence of that switch, you now get a 6-year spread of the positive adjustment that you have to take back to income. So, the first read said, well, hey, that's great. And then all of a sudden, the devil in the details, if you will, it's like, well, there's a nuance in the banking industry because of how subsidiaries are formed. And then there's, without getting into all the technical legalese, a Q sub is sort of treated differently when it reincorporates. So guidance in that area would be great. Bank-owned life insurance as it relates to acquisitions that organizations do. There was maybe some unintended language, if you will, in some of those transactions that, we did get some proposed guidelines, but we'd love to have those finalized that says, no, that was an unintended consequence, and you don't have to go to those lengths with bank-owned life insurance when it comes to an acquisition of someone that you've done. And then I guess another, surprise for me was, as you talk to others, around the country, as you go to seminars and you meet other professionals, I guess I'm sometimes surprised that others don't like to read as much on these provisions. So I guess there are different levels of professionals around the world, and I know there's people who read more than I, and that's all fine and good, but I think we as a profession owe it to ourselves to, really take on the challenge to understand the spaces that we play in and what the tax rules are.
I think one of the hardest things that I'll admit I struggle with it, right, Gary? Is there's the day to day keeping up with that. There's a lot of things kind of coming, and maybe again, to use a metaphor, it's you're balancing a lot of plates and keeping them all spinning at the same time. But how do you balance that and make the space in your day, to keep up with some of these changes, particularly in the last 19, 20 months here with tax reform, because those changes have just been so fast moving.
Yeah, Damien, I guess, just being intentional. I can't remember the author of the book, but it was off balance on purpose, because everybody wants to be on balance, right, and perfectly within Covey's 3 circles. But, sometimes today this is, a client need takes precedent over, your studying, or a marketing need takes precedent over something else. But trying to find that time, whether it's the first 15 minutes of your day, the last hour of a week, going through your daily emails and doing nothing but technical reading, making notes. You don't have to read everything, but check out the bullet points. Is there something there that resonates with you? Because seeing it's one form of learning, reading it's another form of learning, writing it down is yet another. But if you find an article that's on point, print it out. It's just being intentional with your time. Our minds are an amazing thing, and our ability to recall, whether it's the answer or whether it's the name of someone. Paul Revere writes the punchline, right? 2 people went off that night to tell the people the British were coming, but Paul Revere was the one they remembered because he actually knew people who knew people to get the message out.
It's all part of it. I think, right, is balancing. That's the hardest part of it, the job sometimes. But also, again, what keeps it interesting, right?
Absolutely. Well, and that's what our clients deserve.
Yeah, and I guess to that point, because I feel like part of this, keeping up with it, tracking it, synthesizing it all is to then figure out, well, what do you do with it now that you've had a chance to see what it's meant for financial institutions to apply these provisions? What are some of the actions or planning steps that taxpayers should be taking?
I think strategically, when I think tax planning, taxes, if you will, they are a byproduct, right? If you want to pay no taxes, make no money. But that's not a good strategy. In our financial institution client base, it's planning around ownership succession, it's planning around management succession, those things that take about running a business. So when I think about our S corporation clients and our regular corporation clients, when's that next shareholder going to pass away? And what would it cost us to buy those shares back if they came back? And so are you modeling out, if you will, should I be a regular corporation or should I be an S corporation? S corporations, for the most part, are still a great strategy for lower taxes because double taxation is still more expensive than one layer of taxation. So the tax you pay at the corporate level, whatever's left over, you dividend out the rest. You're going to pay more tax than if you were an S corporation. On the contra, though, if you're not going to pay out dividends, you can retain more capital as a regular corporation. So how do we get to the table to talk to our clients about what is their business goal? And taxes can play a big role in that. So S versus C is very important. Accounting methods are very important. Talking through, should we take Section 179 or should we take bonus depreciation? And understanding, if you will, the state tax consequences of those decisions. If you look in our market here in Decatur, Illinois, we have a large enterprise zone. And just for state purposes, if you Section 179 something, you've now used up all your basis and it's not eligible for that little credit. Well, if you take 100% bonus depreciation, you still have basis, which is eligible for the credit. So those little decisions that we make related to fixed assets can play a big role. But most importantly, I think it's educating our clients on what the rules are. Had a call this morning with a client, and they're talking about how do you educate us when there's issues like with tax reform. And it's like, well, I need to help you understand the difference between the tax treatment of a ball ticket, to a U of I football game versus the meal down the street at the steakhouse before or after the game. Because if they can code it correctly on the front line, then it'll make it easier when they book the accounting for income taxes on their end. It'll also make it easier and more accurate when we get ready to prepare the return. And so it sounds so, if you will, mundane, but our clients want to know how to do it and how to do it correctly so that they can get on to doing something else, spending their energy more effectively. So to me, it's having those sit-down conversations with our clients, explaining through the details, and that conversation, kind of like you and I are having now, they want to learn.
I like how you say that too, is, it's kind of maybe to put it differently, they do what they do best and then outsource it to you and I, and we're able to kind of focus on that so they can keep on focusing on what they're good at, right?
That's exactly right.
Is there anything else that maybe you'd add to the conversation? Anything particularly interesting, again, that you're hearing from an industry perspective or how these provisions are playing out?
And I guess one space I would go that we don't quite know yet, in the spirit of tax simplification, the IRS appears to, based on what Treasury's done here, is try to go towards more conformity between book and tax. And so, for example, mortgage servicing rights, there was specific language put into the tax reform that said, no, book and tax don't have to be the same for mortgage servicing rights, because GAAP has long established that future income stream for servicing this pool of mortgages is a financial asset that a bank can put on their books and records and then count as capital and book income. Yet for tax purposes, the income is derived when they take the person's coupon payment and they're allowed to retain part of that servicing right. So I guess what else is out there in the accounting world that, if we're unsuspecting, may create a book income that becomes taxable income because of this conformity? So time will tell as that develops. From a professional standpoint, I think we have to sit back a little bit and we just need to have patience. We all want the answer right away. But again, as I said at the onset, the 86 Act over decades and decades was developed and litigated and then brought full circle. Not even sure I answered your question, Damien.
I think you did. Great perspective and great, especially the patience one. I mean, that's been hard. It really, truly has, because I mean, especially with maybe something that's different now versus then is just in the age of social media and articles and blogs, and I mean, there's this we're kind of used to being able to have this instant access to information and perspectives and all that, but at the same time, it's kind of you got to be patient a little bit here and sit back, and we're not going to know the answer. So it's been sort of a challenging thing to balance, I guess. I'll share just from my own personal perspective on that.
Yeah, and if you've got a magic pill for that patience, I'm all for it. I try. I'm just not there every day.
Yeah.
But
No, it's not an easy one for sure. Not an easy one. And from the conversations that I've been having, you and I aren't alone on that one. So no magic bullet on my end. But yeah, I don't know, Gary. Anything we haven't talked about that perhaps is on your mind, or you want to make sure we visit?
a final closing point I would throw out there is I've always enjoyed in the profession and I think it goes with any profession is the fact that people look to you for guidance, for answers. And when it came to reform, the inherent trust that I gathered our clients place in us was even greater than I had understood before tax reform. There are some that just have that inherent trust in our abilities, but when you think of it from a professional standpoint, it just reiterates the importance of reading and doing more. I would also then add that there's been a stair-stepping in the past few years of a lot of, I think of it as tax simplification. Folks don't. But you go back a few years and things that now we've forgotten, like the repair regulations. Okay, how was that simple? Well, the IRS basically said they're tired of fighting about fixed assets and whether you capitalize something or you depreciate it or expense it. And they said, look, here's a few rules. What were they? 200, 300 pages of regulations? Okay, maybe not simple, but it at least laid a framework that said, here are the rules, follow them. Well, that's interesting. So now we need to do those things. But do you know that how you apply the repair regulations have differing impacts on parking? Here I go talking about parking again. Woo, really exciting. But if you seal coat that driveway and you treat it as a repair, but your parking facility is strictly for the employees and no one else because it's an operations center, well, now I've directly expensed it for book and tax, which is what we want for tax planning, right? But now I have to add it all back because it's disallowed parking. Well, do I have to expense it, or can I capitalize it and now write it off over depreciation and not have to add it back for parking? Well, that's interesting. Okay, so here's the repair regs and applying that knowledge to tax reform. Estate planning, they raised the threshold up north of 11 million now. Well, okay, so does that mean we forget about estate planning because it's not important? Well, I think our owners of our institutions need to consider estate planning. Word on the street in our neck of the woods is sometimes banks sell because a shareholder needs liquidity to handle the estate tax. So is that to our advantage if we're buying someone, that we understand who the shareholders are and whether they have an estate tax, or if our client is going to be in that situation? But then what happens in a few years when the 11 million perhaps goes back? So the IRS said, hey, let's make it simpler. If you own less than X, you don't have estate tax anymore. So I do think of it as simplification. If we have a simple life, it is simpler. In the banking space, what's going on? I mean, it's probably too early for stats on this, but what's happening with their mortgages and second mortgages? Now, all of a sudden, if you borrow on a line of credit to pay off a credit card, that interest isn't deductible anymore. Well, does that change the economic behavior of their customers? Maybe, maybe not. How about people who have mortgages, but now because $24,000 is the limit on standard deduction for married filing joint, they're not itemizing anymore. So are we talking them into buying bigger homes so they can get more mortgage interest, or are they not borrowing? So how do we understand the taxes that then drive our economic behavior? Again, I digress, but there are a lot of applications of tax reform that if we sit back, spend a few minutes thinking about how it impacts our day to day, there's a lot of fun to be had, and frankly, a lot of tax monies to be saved.
Thanks again for joining us for our Back to Tax Reform series. Let us know what you thought with a review out on Apple Podcasts and drop us an email to simplytax@pkd.com. You can find me out on Twitter at Damien Martin CPA, on Instagram at TaxDad, on YouTube by subscribing to our Simply Tax YouTube channel, and on LinkedIn.
I'm Professor Damien Martin, and thank you for listening.
The information contained in this episode of Simply Tax is based on data available as of the date of its release. BKD is under no obligation to update this information if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances. Any information provided is not to be considered as tax, legal, or financial advice. Please consult your tax advisor before acting on any matters covered.